This is tutorial 2, gaps or fading the gaps. Gaps occur in the market when price opens higher or lower than the previous day's close and creates a gap in price as action is shown here. These are 60-minute candles, and on day 2 we gap up. Note how the open on day 2 forms a gap up above the previous day 1 high. When the market opens above the previous day's high, it's called a gap up. On a gap down on day 2, we see the reverse. This is the end of day 1 and we gap down. When the market opens below the previous day's low or candle, it's called a gap down. So here we are trading the gap. First you identify the gap, then you identify your target entry price, which is just inside the low of the previous day's low. This is your calculated entry for a long. As explained previously, we're fading the gap and will trade counter trend. You'll also target your stop loss, which is below the gap down of the day on day 2. This is your calculated maximum risk. If the price reverses back down to your stop, you'll be taken out of the trade. And the last step is you target your exit price. On a gap up, again, identify the gap, identify your target entry price, which is just inside the previous high of day 1. Your stop loss would be just above your day 2 gap. That's your calculated maximum risk. If price reverses back up to your stop, you'll be taken out of the trade. Then you target your exit price. This is a calculated method which is accurate and safe. Your stops limit your risk. So what you've learned, we will only fade gaps in the direction of the current market trend. This will increase our odds of success, and as such we will ignore all other signals. In this example of a gap down, we are trading counter trend. The trend is up. So on this gap down, which is also this area right here, it's an enlarged example. This gap down to the moving average, we take the trade long and fade this gap down. In this example, EOG Resources is trending up. Therefore, any gap downs that we decide to trade, we will fade to the upside and take a long. In this example of US Steel, the trend is down, so any gap up we will fade and short. We'll have our stops above the high of the day, and we'll ride this trade to the downside. In this example of Apple, we can see that the trend is down. We have a gap up, which we're going to fade, and we trade this to the downside. There are several other signals in here. A gap up, but we're not going to fade the gap up. We also have a gap down here, but because the trend is down, we're only going to fade the gap ups in the direction of the trend. In this example of Teradyne, we are in an uptrend, and we have a gap down here. Because we're in an uptrend, we're only going to fade the gap downs to the upside and take a long here. We'll ignore the gap ups. In this example of Prudential Financial, we had been in a uptrend since 2011 summer, and we had this gap down which also formed a hammer, which is a great opportunity, putting our stop down below here to enter long on the next day's candle. So again, we're fading the gap down on the trend up. So we're taking a counter trend trade. Also notice, because we're in an uptrend, we only fade the gap downs. We had gap ups, we didn't trade those. Okay, so we ignore those trades with this particular technique. In this example of Hess Corp, we're in an uptrend. You can see the 10 period and the 50 period are rising, and we have a gap down on September the 5th, 2012. We could take the next trade or the next day's trade and go long once price opened and headed in the right direction. Okay, again, so we're in an uptrend. So we only fade gap downs and trade counter trend. I hope this helps you with gap up and gap downs. Be sure to backtest this on trades that you've traded in the past and see how you may have increased your odds and your outcome.